When you think about building real wealth, the first thing to understand is that putting all your eggs in one basket is a mistake. This is particularly true when it comes to holding a single type of currency. Economies fluctuate, governments adjust policies, and inflation can quietly erode the value of what you thought was a safe store of money. Relying on just one currency is a silent risk that can catch even the most careful planner off guard. You want to think in terms of stability and resilience. If you keep all your reserves in one form, you're exposing yourself to political decisions, fiscal pressures, and economic shocks that are beyond your control. Just as a business spreads its risks by diversifying products or markets, individuals should do the same with their financial holdings. Holding a variety of currencies alongside real assets can protect your purchasing power over time. History teaches this lesson repeatedly. No single currency has maintained absolute dominance forever. Political upheavals, wars, policy mistakes, and economic crises have repeatedly reshaped the value of what people once considered safe. Those who recognized this early, who kept a portion of their wealth in other currencies or tangible assets, were able to navigate storms without losing ground. Those who didn't often learn the lesson too late. It's not about trying to predict which currency will surge or collapse next week. It's about preparing for uncertainty. Life is full of surprises, unexpected crises, sudden changes in interest rates, or shifts in global trade. When you spread your financial exposure, you create options and flexibility. You are not betting on luck or timing the market perfectly. You're building a shield against unpredictable events. Equally important is thinking in terms of balance. There's no need to overcomplicate or over-diversify in ways that make your life difficult. The idea is simply to avoid concentration in one place. A measured approach, one that blends different currencies, investments, and real assets, provides both peace of mind and long-term security. Over decades, this kind of prudence compounds. It's not flashy and it doesn't promise instant gains, but it builds enduring strength. At the end of the day, wealth preservation is as much about avoiding mistakes as it is about chasing returns. Relying solely on one currency is a silent mistake, one that can quietly erode your financial foundation while you focus on other things. By diversifying thoughtfully and maintaining a global perspective, you protect yourself from risks you cannot control. That's the kind of sensible, steady thinking that leads to financial resilience. When you think about building lasting wealth, there's a fundamental principle that cannot be ignored: the value of owning something tangible. Paper promises, digital numbers, and abstract contracts may have their place, but real wealth is grounded in things you can see, touch, and hold, assets that have intrinsic value. These are the things that endure over time, survive economic storms, and provide a foundation that paper alone cannot match. Real assets have a way of standing the test of time because their worth is rooted in actual utility or scarcity. Land, property, productive businesses, and certain commodities are not dependent on someone else's promises to pay. They serve a purpose, satisfy a need, or produce something tangible, and that is why they carry value even when markets are volatile. Owning these things provides not just potential returns, but also a sense of security that cannot easily be shaken. Many people chase the latest investment fad, looking for quick gains in instruments that exist only in the digital realm. But history is clear. The wealth that lasts is built on what is real. When you own productive assets, you have something that works for you, something that can generate income, something that grows in value with careful stewardship. This is not about speculation, it is about being patient, thoughtful, and deliberate in choosing assets that will hold their worth and often appreciate over time. There is also a psychological benefit to owning real things. When the market is turbulent, when numbers on a screen rise and fall wildly, it is easy to panic or make rash decisions. But tangible assets provide a grounding effect. They remind you that value is not a fleeting idea, but something that exists in the real world. They anchor your perspective, making it easier to make rational decisions rather than being swept up in every headline or rumor. Owning real things also forces discipline. They require you to understand what you are buying, the dynamics of the market, and the factors that influence value. This kind of focus and due diligence encourages long-term thinking and discourages impulsive moves. It is a methodical approach that aligns with the principle that wealth grows steadily when nurtured carefully rather than chased recklessly. Ultimately, the lesson is simple. Wealth built on tangible foundations is wealth that endures. Financial instruments, while useful, are often contingent on promises, policies, or perceptions. Real assets have an enduring quality. They are productive, scarce, and tangible. By owning these things, you are not just investing in potential gains, you are investing in resilience, stability, and peace of mind. Over time, this approach rewards patience, insight, and prudence, and it lays the groundwork for enduring financial strength. One of the most important lessons in building lasting financial security is the value of spreading your risk. Concentrating all your resources in one place may feel efficient, but it is also risky. Life and markets are unpredictable, and unexpected events can quickly undermine even the most carefully laid plans. Diversification is not about chasing higher returns. It is about protecting what you have and ensuring that a single setback does not derail your long-term progress. Diversification is a simple concept, yet its power is profound. By owning a variety of investments, you reduce your exposure to any one failure. If one company, sector, or asset class suffers a loss, others can offset that impact. The goal is not to eliminate risk entirely. That is impossible, but to manage it intelligently. Spreading your investments thoughtfully allows you to sleep better at night and avoid decisions driven by panic or fear. History provides countless examples of why this principle matters. Markets can be volatile, and economic cycles often take unexpected turns. Companies that once seemed invincible have faltered, industries have been disrupted, and entire sectors have collapsed. Those who had all their wealth tied up in a single idea or asset often paid a heavy price. Those who diversified, on the other hand, were able to weather storms, maintain their capital, and even seize opportunities when others were retreating. Diversification is not just about numbers. It is about thinking carefully about the nature of risk. It requires understanding how different investments relate to each other, where vulnerabilities exist, and where protection is needed. It is a form of insurance, one that is earned through patience, analysis, and discipline rather than a contract with a company or a bank. Over time, this strategy can make the difference between building enduring wealth and being at the mercy of chance. It is also worth noting that diversification encourages a broader perspective. By considering multiple avenues of growth, you gain insights into different industries, markets, and economic forces. This knowledge can guide better decisions both in selecting investments and in managing them over time. It prevents the tunnel vision that often comes from overconfidence in a single idea, reminding you that the world is vast and opportunities are many. At its core, diversification is about prudence and humility. It is the acknowledgement that no one can predict the future perfectly, and that protecting your resources is as important as seeking growth. By spreading your investments thoughtfully, you build resilience against unforeseen events while maintaining the potential for steady, compounding gains. In the long run, this approach rewards those who are patient, disciplined, and mindful of the bigger picture, ensuring that wealth endures even when uncertainty strikes. The key to building lasting wealth is not in chasing short-term gains but in understanding and embracing long-term cycles. Markets, industries, and economies move in rhythms that unfold over years, sometimes decades. Those who focus solely on day-to-day fluctuations often miss the bigger picture, while those who recognize and align themselves with these longer patterns have a distinct advantage. Life and markets are inherently unpredictable. Economic booms follow busts. Industries rise and fall, and innovation reshapes the competitive landscape. Those who try to react to every shift or speculate on every trend are constantly at risk of making costly mistakes. A long-term perspective allows you to see beyond temporary setbacks and to hold steady through periods of volatility. By keeping your eyes on the broader cycles, you position yourself to capture the enduring opportunities that most people overlook. Cycles are not about timing the market perfectly. They are about understanding the forces that drive growth over time. Demographics, technological innovation, societal change. and government policies all move on their own schedules, often unfolding over years. Companies that are aligned with these forces tend to grow steadily, while those that are out of sync struggle. By focusing on long-term trends rather than short-term noise, you can make investments with a much higher probability of success. Patience is essential when thinking in cycles. Value compounds slowly and steadily, and short-term setbacks are inevitable. Yet, the investor who recognizes that markets have ups and downs is not deterred by temporary declines. Instead, these moments become opportunities to reinforce positions in quality companies or assets that have strong long-term prospects. Wealth grows most reliably when nurtured over time, rather than chased impulsively. Thinking in cycles also encourages a disciplined approach to decision-making. When you understand that growth and contraction are natural parts of any system, you are less likely to overreact to temporary events. This discipline allows you to focus on fundamentals: the strength of a business, the sustainability of its competitive advantage, and the trajectory of its industry over many years. These are the factors that matter far more than daily market chatter. Ultimately, a long-term perspective is a mindset. It requires humility and foresight, a recognition that no one can predict every market movement, but that trends and patterns can be observed and leveraged. It is a strategy grounded in patience, understanding, and careful observation. Those who commit to this way of thinking are rewarded not by quick wins, but by steady, compounding growth over time. By embracing long-term cycles, you protect yourself from the distractions and volatility that so often derail others. You position yourself to take advantage of opportunities when they arise and to weather the storms that inevitably come. In the end, it is this commitment to thinking beyond the short term that separates those who achieve lasting financial success from those who are swayed by the constant noise of the moment.